Welcome to Advanced Tax Implementation. In this short topic, we're going to give you an overview of the tax engine. So starting with this slide, summarizes everything in terms of provided by this advanced tax engine. So we've got a single point solution. So whether we're defining in terms of procure to pay, order to cash, expense tax, global, so whether we're looking at some form of tax based on in terms of jurisdictions, whether we're based on a country such as a VAT, or whether we're based on a combination of a location and the VAT tax which occurs in some points, we've now got a single point of definition. And it can be as simple as defining the core regime to rate configuration, so a whole host of simple rules and exceptions, and then on top of that we can put some more complex rules to drive all the exemptions and exceptions. So our ultimate aim is to end up with a tax configuration that meets the reporting requirements given to you by each of the different tax authorities, and we've got a robust tax repository allowing us to do our internal reconciliation management reports as well as our external reports for audit or reporting to the various tax authorities. We also give an ability to, if you like, contact web services with some of the tax partner products, such as Vertex Taxware. Currently, if you're implementing the cloud, then USA and Canada, you can use the Vertex O Cloud series to load your locational tax rates. If you're on premise, you've got a choice of other configurations. Let me just take you to the starting point of the implementation guide. So if you go to docs.oracle.com, look for the books and look for manuals, then this is a really nice, in terms of summary really of the slide we just looked at, and emphasizes with a little bit more detail. You've got similar in the text under your eKit guide there. So we've got a single point solution. So we don't manage tax in projects, in purchasing, in payables or receivables, as we might have done in older releases of Oracle. In the cloud, we've got this one-stop shop to do the configuration for any type of transactional taxes and also for withholding tax. For the people of payables, you can still use a simplified setup to do payables directly within payables. If you've got more complex withholding tax requirements, particularly for any VAT countries, the recommendation now is you use Advanced Tax Engine to do your withhold taxing requirements. So again, you start to see flexible solution. So we've got a rules-based engine to capture all of the regulations of the tax authorities. That means on your transactions, you've got the appropriate taxes charged and ultimately the appropriate taxes reported. So just some bullet points here. The tax engine, you've got uniform delivery. The event models are coded, such as sales invoice, credit note, purchase invoice, etc. You've got a single integration point where we can punch out to in the cloud in terms of the Vertex Q series to calculate your in terms of sales tax. You've got configuration, particularly for country-specific tax content. There's various localization reports that will drive you to build various reporting types and reporting type codes and attach those to your tax rates, etc. And you've got complete control. So as tax becomes more and more complex across the countries, you've got this rules-based engine. So it's your tax experts, your tax accountants that will code all of these rules within the engine, and the appropriate transaction appears, appropriate tax appears on the relevant transactions, be it a sales invoice or a purchase invoice. Obviously, it's up to you. You can decide that your end users can then have full manual intervention, or with your control concept, you can narrow it down so that they have a limited manual intervention. Probably the ideal is that your tax experts, your tax configurators build all the rules and the end users have little manual intervention because they don't know all the rules and regulations. That's what you code and build into the tax engine. Now, just some of the capabilities, we've then got a further list. You can either have simple or complex legislation. Lots of the Scandinavian countries have VAT, but it's a flat rate for everything, and it's one of the highest in Europe, 25% applied on everything, although as always, when you get to know the detail, there is exceptions. So even in the Scandinavian countries, they've got various items that are zero rated. So it's not as simple as it first sounds. You've got other complex regulations that, particularly if you're moving, exporting goods and services, or you're receiving goods and services from, say, a third country within the EU, then you come across a complex thing called tax triangulation. So there we have to record the ship from, the receiving destination, as well as the bill to. All of those could impact what is the appropriate tax status, tax rate to charge. So that brings us on to this next point. We can configure, very much looking at the place of supply rules, we can have a look at this cross-border regulations or export. So very much on the tax engine, when we determine first party, i.e. the company, the regimes that are applicable, we're then looking at the place of supply. So for taxation purposes, where is the place of supply? Is it a ship from? Is it a ship to? Is it the tax point for reporting when we receive the goods, when we invoice the goods, when we pay for the goods? All of those have to be thought about when we build or consider building and then reporting on the tax engine. Also, if we've got intercompany transactions, various extra rules normally apply if we've got intercompany transactions or differences between, in terms of companies that may be within the same geographical area, they might be in different geographical areas. Normally, there will be specific reporting requirements, particularly say for withholding tax, when you're looking at an input register for VAT and output register for VAT. Normally there's different fiscal requirements driven by the tax authorities again. That means you have to perhaps configure the tax engine to make sure you can pick up and report those codes or grouping of the codes accurately. The last point is probably the biggest selling point of this engine in terms of flexibility. In my experience, in terms of looking at tax configuration in the UK, for a long time, it was set, standard rate was 17.5%. Then in the last few years, it seems to be quite dynamic. It went from 17.5 down to 15, and it's now gone back up to 20%. And you'll find also within that, you get changes to legislation, particularly if they're looking at tax avoidance. Certain products will come in, certain products will be excluded. And one of the things that sums up, I always smile, my example I use in the UK VAT is foodstuffs are normally zero rated, but for some reason the revenue picks on ice cream. Ice cream is actually a standard rated product. So if you're buying any or selling ice cream, we're supposed to put a 20% charge on it. All the other food stuff tends to be zero rated. So that you can pull in all of this from in terms of the financial, the implementation guide. So if I come back to my slide deck, in terms of the configuration of the tax engine, you'll see we've got this single data model used across all the flows, so order to cash, procure to pay. The output, if we look at the right-hand side, is we've got our single source of truth repository, and ultimately all the rules and regulations will drive our tax reporting repository, and from the reporting repository we'll get our internal management reports as opposed to our external tax and audit reports. If we look on the left-hand side, we've got the 5 building blocks from tax configuration down to tax management. So our tax configuration, and this is often referred to as our foundation or core setup, we've got our regime to rate. So it might be, if my typical scenario in the UK is I deal with goods, and they're mostly standard rated goods, then I would set up my regime to rate with all the indirect and direct defaults that the tax is normally, if I ship anywhere from the UK to a UK customer, i.e. the jurisdiction there, my place of supply is in the UK, then normally 20% rate, standard rate applies. Of course, if I'm in an agricultural company, then the chances are my rate or my default would need to be 0, and then the exceptions would be built in to standard statuses and rates. So the cornerstone is our regime to rates engine. If we need to deal with various exemptions and exceptions, then we've got what we see here is our tax determining factors. And conceptually, they're grouped into these 4 Ps: party. So the first party, the legal entity, the third party, our customers and suppliers. And we can have various tax profiles on there that will enhance or be used by the various tax rules. We've got products. Products we can use if we're lucky to have installed inventory. We might have already, or inventory team have already loaded a list of category codes, goods, services, etc. And we can use that in our rules engine. Place, obviously geographies, zones will be driven in our places. Processes, tax classification, account codes, the type of document, sales expense, all of those things are grouped and will be used as what's referred to as a determining factor in a condition set, and we can build our if-then logic. So if we ship from the UK to somewhere in the EU and we've got the registration number, then we might have to use intra-EU sales. That type of concept you can build with any of these party, product, place, process in terms of, or combination of them. If we look at the advanced configuration, this is in effect in terms of applicability, this shows you what the rule engine considers. So every time there's a call in the event for my invoice, my purchase invoice, then the system will assess these rules. What regime is applicable, including what jurisdiction is relevant, what's the place of supply. So typically in a VAT, it would be a ship from. In a location type tax, as in the USA, it would be a ship to. The registration, probably the bill to party. Taxable basis, there's a seeded formula, but you can create your own. So the seeded formula takes the line amount and then times a particular rate. And we come then to recoverability. In a VAT system, normally there's a recoverable. So in that input VAT, we can recover what we've paid for our purchases and offset that against the output tax. That's normally the last thing that is in terms of calculated. So the advanced configuration there really shows us what the rules engine goes through, the different tasks to work out whether tax is applicable, what rate is applicable. The services the tax engine provides, you'll see, is this tax and calculation of recovery rates. And you can punch out in the cloud to Vertex Q. So Vertex Q, in terms of cloud integration, that might just load the core configuration of the locations, the state, city, county. It might do the tax calculation. It might also do the tax reporting. So in our partner integration, we've got choices of what we do in terms of integration. If you're not perhaps using USA sales tax, but you're implementing in other countries, then the chances are it will be the rules you define in the tax engine that will be your default point. At the bottom, everything you do in terms of the tax calculation goes into the repository and reporting, and we use the tax reporting in terms of repository. That will extract the data into an interface table, and from that you could build in your input output in terms of tax registers. There's also specific registers specifically for sales tax, and all the country specific coding for different VAT type reports. So back to looking at our determining factors, then this is the key building blocks. So whenever you're looking at tax, and as I've already hinted, tax is best left to the tax experts and perhaps your business flow experts, but once they've told you the rules and regulations, it's relatively simple to capture those in the tax engine module. So first of all, we'll think about the parties. So who am I? So who am I customer? What customer suppliers do I have? Place, where do I operate? What types of product? And the type of process. And all of these would be evaluated, as I've already started to put the tax authority and all the exceptions and exemptions are built around conceptually these 4 building blocks. So if we've got an inter-EU movement, then very specific intra-EU regulations come into place where the place is there. Party, you can think about being registered. Yeah, if you're below the registration threshold in most places, you're not registered. That means you don't have to apply transaction tax to those customers or suppliers. Products is normally most regulations. You'll find products are grouped into various things such as standard rated, 0 rated, exempt, And in Europe now, you can have up to 2 special rates. So in terms of those special rates will be a reduced rate. The UK example, typically for utilities, gas and electric delivered to the home, that's a special rate of 5%. Process, whether it's an intercompany, cross-border, again, all of those might influence the tax or the appropriate tax that's charged on a particular invoice or received on a particular invoice from your suppliers. In terms of minimum setup, often referred to here, look as the foundation tax configuration. So our starting point is we define the legal entity and business unit. So against every transaction, there'll be a first party stamped in terms of legal entity or business unit, and that will be stamped in a particular country. Also, probably the jurisdiction will be important there. In a VAT system, the jurisdiction, you could argue, is simple because it's the whole country. In terms of when you're setting up a location tax, and it could be county, city, state or province, that also will be associated with that global configuration owner, or the configuration regime, legal entity plus the jurisdiction. We've then got the regimes. So in terms of your regimes, that's the set of rules that go for the treatment of one or more taxes on behalf of a legal authority. You've then got a tax, which is a charge, if you like, imposed by a government through the authority. Under that, you've got the nature of a product or services, which is the tax status. We've then got the tax rate, and what they don't show here is a recoverability. So in a VAT system, you'd also have the recoverability. So all of that is outlined in a regime to rate in terms of configuration. And we'll see this in later chapters. I've sort of put out here a more step-by-step building blocks. So the tax authority that you would register. So it will be in terms of legal authority, either for reporting or collecting purposes. The tax regime. So that's a set of tax rules in terms of in a treatment of one or more taxes administered by a tax authority. The classification of a charge is the tax. Jurisdiction, that's the geographical area where one or more tax is levied by a specific tax authority. Taxable status is the nature of a product or service. Taxable rate is the rate for a specific product over a period of time. We've got the recoverable rate. If you're selling goods, the recoverable rate tends to be 100%. If you're doing services, then you might find that's recoverable rate of 0. And business unit tax accounts, that will determine how we match our tax charged in the subledgers with our GL codes that we're reporting in the cloud general ledger. So I've included this in my later chapter. You'll find some typical examples of our regime to rate setup. And this really shows the split between a location tax and a valid added tax, the two type of extremes. So top one, US sales tax. Notice there we've got taxes. So you'd have a regime, US sales tax, and typically you would apply taxes such as state, county, city. And notice under those state, county, city, the jurisdiction would be king. So Georgia here would have a 4%, New York would have, say, a 5%, county, Dubac would have 7%, and here City of Atlanta has a 0%. So on a location tax setup, potentially here, you'll see you've got 3 taxes under regime, and the complication there is the jurisdiction plus the tax. If we look at the bottom example, where we're looking at the GB VAT, notice there we've got a single tax called valid added tax, but the complication there comes in the status. So based on, say, the customer or products, we've got standard customers' products that are standard rated, which is currently 20%. You've got a reduced rate, which is various utilities and a few other products. We've then got in the UK products that are exempt, and you've got products that are 0 rated. And normally in a return, we have to account for those differently. When we come and fill in our VAT tax return, you'll have different boxes to record what's standard rated, reduced, exempt, 0. But also on top of that have to record what's been exported and what has this special regulation of an intra-EU movement. Now, if we look in the middle, we've got Canada. And in terms of Canada, you'll find you've got a goods service tax, province service tax, and harmonisation sales tax. And you'll find in terms of that is a sort of combination. Harmonisation sales tax now is replacing the goods service tax and province service tax. But as in the older setup, The province servant tax was a tax on tax. So government service tax, and then province sales tax was added on top of that. So we've got an inclusive tax. So you see there, we've got in terms of examples of the different regimes, of the different tax codes that you may come across, a location tax and a VAT type tax. And that really concludes in terms of this first part of the presentation. We're going to go on to a demo where I'm going to show you having a look at in terms of using the tax simulator to define the foundation tax plus a rule.